Hello and welcome to the latest Insider interview. Our guest today is Raheel Altaf, manager of the Artemis SmartGARP Global Equity Fund. Raheel, thanks for coming into the studio.
Thanks for having me. It's good to see you.
You're running a systematic strategy, so computers help you generate trade ideas. You also have an active element in there as well. So what is the process for you making a change in the portfolio?
Yeah, so the way we kind of think about trading, it's ultimately about conviction and confidence. So we find a company we like, we do the due diligence, we're ready to invest in the company. We'll typically start with quite a small position size. And that position will then gradually build up in the weeks ahead as there's more confirmation that the opportunity is there. Why are we doing it in this gradual way? It's basically to make sure that we're not messing up on market timing, but also to give greater weightings to those companies that have persistently looked attractive. So if you look at the capital allocation, the way it moves around in the fund through time, we're basically shifting money into the best opportunities in a gradual but very persistent fashion. And then the other side of that is, if the catalyst that we've identified doesn't follow through in a company, or we start to see deteriorating corporate news flow, for instance, we're quite disciplined about cutting our positions. We're happy to go elsewhere and find new opportunities. And so that's really the way the capital allocation works, and that's what triggers turnover in the portfolio.
And how many stocks do you typically own, and what is the turnover like? How often are you trading over an annual period, perhaps?
In an ideal world, the stocks that we hold them for a very long period of time. And so there's a portion of the portfolio that we have held for a number of years, and we do tend to run our winners. But as I mentioned about the discipline about cutting your losses or cutting those that aren't following through with catalysts, there's a bigger tail of the portfolio that might be smaller, where we're just much more aggressive about turning it over. And so if you look on average, the typical holding period is between 6 and 9 months. But that really masks the fact that there is a big portion of the portfolio that's been around for quite a long time. And there's more tinkering with the tail of the portfolio, where you're really trying to get it right and you don't have the confidence yet. So it's just an incremental process where you're building confidence through time, adapting to the market environment as it changes.
And how many stocks are there typically, and why are position sizes so small? The top holding is about 1.4% of the portfolio.
Yeah. Look, if you speak to a typical fund manager, they will give you great insights about an individual company. And they might be making decisions about whether Exxon is, better than Shell, let's say, or whether AstraZeneca is a better investment than Glaxo. Our approach is slightly different. We're slightly less conviction on that differentiation between the two companies. But what we have high confidence in is companies that share similar attractive characteristics stand to do well. So for example, if you look at the companies that are delivering increases in profit forecasts, let's say, or dividend forecasts, or that are generating more cash than others, or you focus on companies that have made consistently good investments with their capital, that gives you a group of companies that you can invest in. And there we have quite high confidence that if you invest in that group of companies, you're going to deliver good returns through time. And so yes, the approach is you're much more diversified than a more concentrated offering. But as you've seen with the fund, it's also high active share and has little overlap with the benchmark index. So position sizes are really determined by the opportunity. And I'd also say when we have less exposure to some of the larger companies in the market, then the top position sizes can be a little bit smaller. The active share is in excess of 80% typically, so it's around 86% at the moment. So that means very little overlap with the benchmark index. And typically in terms of the number of stocks, it's more than 100. So we've got about 120 or so at the moment. So it's a very diversified offering.
Can you talk me through some of the top positions in the portfolio? Why are they there, and what fundamental characteristics do they share?
Yeah, the characteristics of our top positions are similar to the characteristics of all of the companies in our portfolio. Typically, these are companies that are trading on reasonable valuations, in some case, very depressed valuations, where the growth characteristics are quite good, where there are some economic tailwinds in place, and where you're starting to see profit forecasts for the companies, really going up over time. And so, I've mentioned that, we are spread all around the globe. If we look at the portfolio today, we have a couple of positions in China, for example, China Railway Group, which is one of the large infrastructure companies within China, trades on almost a third of the market valuation, or even less actually. And there's a commitment to infrastructure spending in that part of the market, but people aren't interested in boring railway stocks. They've been looking at new economy companies. And so this is a company that's really been shunned for a number of years, but actually has been delivering quite good growth and is now trading on a really depressed valuation. So, we're quite excited about that sort of opportunity, and it's in our top 10 positions.
You don't look anything like the index. There's no Apple or Alphabet or Amazon in there. So why is that such a good way of investing?
I think it's one of the key ingredients to delivering, good performance in the long term. And ultimately, we know that you can buy the index very cheaply. It's easy to replicate. Our job is really to outperform the market. And so one of the key ingredients to doing that is to make sure that you are not like the market. And there are times where we will have exposure, to some of the much larger companies that make up big index weightings. But in general, we have a bias towards mid and small cap companies. And many of those, deliver very good returns, and they tend to be overlooked, by funds that, are closely hugging the benchmark index. So it's a high active fund, but it's one that is quite agnostic about where the best opportunities might be in the future.
Has there been a shift in the top stocks in the portfolio over the last couple of years, as we've seen a shift from growth to value shares performing best?
I think if you look at the top-down environment, things have really materially changed in the last few years. So we've got, an environment where we have stickier and higher inflation. We've got an environment where central banks have had to move into a tightening mode, and we've had much higher inflation than we've expected, and that's had quite big ramifications for global markets. In terms of what we've been doing, we have been shifting to more of the inflation beneficiaries, if you like. So financials and banks in particular, make up a larger part of the portfolio than they have done historically. Elsewhere, if you look at energy and commodity stocks, they also feature more prominently than they have historically. So there's a change in the economic environment, that is a catalyst for much better performance of the underlying companies that benefit from that. And that's, feeding through into the portfolio changes.
So that makes your portfolio quite value driven at the moment. What would cause you to invest in more growth stocks?
Well, I would argue that the stocks that we have exposure to do have, good growth characteristics. And historically, if you look at, the earnings and the cash flow growth that our portfolio has delivered, it has been far superior to that of the market. It is just slightly curious that, many of those companies happen to have, depressed valuations at the moment. What would make us go back to, some of the premium valuation stocks? Well, at the moment, the gap in valuations between cheap and expensive companies has become quite extreme and quite stretched. I think if that starts to revert back to more normal levels, then the opportunity set in those growth stocks will look attractive again. But at the moment, we're seeing many risks to some of those high growth parts of the market. And I don't think those are reflected more broadly in investors' portfolios. It's still, a popular and overowned part of the market. And so I think it might take a few years before, we become very enthusiastic about high growth stocks again.
And what are those risks to high growth stocks at the moment?
Well, clearly, higher inflation and the fact that you've got, parts of the market where you've seen a lot of speculative activity that has led to overvaluation. And the overvaluation is really based around, growth that might materialize far out into the future. But clearly, as interest rates go out, that discount rate increases, and the potential of getting those earnings now, the price of that now should be lower than it was historically with much lower rates. And that's clearly a challenge. I think, given we've had a decade of very strong performance for high growth stocks, we've had a period of a couple of years where we've seen a lot of speculative activity. And that has led to loss-making companies that are pre-revenue, gaining very big market caps. And I think, we're starting to see that unwind quite dramatically, and there's probably more to go on that side of things.
Emerging markets are one of the biggest overweights. Why is that, and what sectors and companies are you finding opportunities in there?
Yeah, the opportunity in emerging markets is really highlighted by our investment process. So a process that is fundamentally driven, is evidence-based. When you look at the best ideas, almost 40% of them are coming from emerging market stocks. So, the process is telling us there are lots of companies in emerging markets that look attractive today. Why is that? We're seeing some signs of positive catalysts coming through. In the short term, clearly, China's reopening is likely to be, a good tailwind for Asian economies and the rest of the world. But if we look towards the longer term, and I think the longer term views have really taken a bit of a back seat with emerging markets. You've got younger working populations, you've got, increasing middle classes, and you've got much more self-sufficiency within the underlying economies. And I think, these are likely to be the drivers in the future, and that's why emerging markets look quite exciting today.
The UK is about 10% of the portfolio. Is that typical? And what are your best stock and sector ideas in the UK market?
Yeah, so 10% sounds quite low, in context, but the index weighting for the UK is around 4% at the moment. Going back a decade, the index weighting was around 10%. So we've seen a significant decline in the UK equity market, and we've experienced that quite firsthand. Why are we optimistic about UK stocks, and why do we have a modest overweight towards that part of the market? Well, again, dirt cheap valuations. We're starting to see much better evidence of improving earnings outlook. And actually, when you focus on which companies in the world are generating more cash versus their size, the UK really stands out as a market. So we've got a diversified exposure to the UK market in some of the large cap areas of the market, in financials, in energy, but also in some of the more consumer focused parts of the market.
Is there one sector in the UK which is particularly attractive at the moment?
Yeah, if we look at the biggest sectors in the market, we think about financials in particular. Banks look quite attractive, but also energy. Within energy, I think we're seeing some quite interesting trends. If you look at the fundamentals of Shell, for example, which we hold in the portfolio, clearly we've seen energy prices rising in the last few years. The company has been plagued by some of the challenges that come from ESG investors, let's say, and also a very difficult decade where we've seen slowing demand from the likes of China and various other parts of the world. And that has led to a drop in terms of capex and investments that the company has made, and they've had to clean up their balance sheet. But now, as we're starting to see profits rising, those are being fed back to shareholders, and the company's buying back stock as well. So you've got a company that trades on a depressed valuation, is out of favor, is starting to see some tailwinds, and it's delivering very good returns to shareholders. So that part of the market looks quite attractive to us.
And finally, the question we ask all of our guests: do you personally invest in the fund?
Yeah, we do. We invest a lot of our own money in the fund. I think the advantage with Artemis is that we get to run money, in line with our own investment beliefs. And so we're very comfortable putting our own money into the fund. And that does mean that we share in the client journey through time, as well as obviously taking the fiduciary responsibility of running those assets very, very seriously.
Raheel, thanks very much for coming into the studio.
Thank you.
And that's all we have time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.